Good morning, ladies and gentlemen. I'm Akash, moderator for the conference call. Welcome to DSM Fresh Foods Limited H2 and FY26 earnings conference call. As a reminder, all participants will be in listen-only mode, and there'll be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on a touch-tone telephone. Please note, this conference is being recorded. I would now like to hand over the floor to Ms. Mehal Gogia from Go India Advisors. Thank you, and over to you, ma'am.
Thank you. Good morning, everybody. It's my pleasure to welcome you all on behalf of DSM Fresh Foods Limited. Thank you for joining us today for the H2 and FY26 earnings call. Today on the call, we are joined by Mr. Dipanshu Manchanda, Managing Director and Chairman, Mr. Saurabh Gandhi, Chief Financial Officer, Mr. Akhil Gupta, Chief Strategic Officer, and Mr. Harsh Agarwal, Founder's Office. Please note that today's discussion may include certain forward-looking statements. Therefore, they must be viewed in conjunction with the risks that the company faces. I now invite Mr. Manchanda to present his opening remarks, after which we will open the floor for Q&A. Over to you, sir.
Thank you, Mehal. Good morning, everyone, and thank you for joining us today. Today is a very special moment for all of us at DSM Fresh Foods as we complete 11 years of our journey of building, learning, evolving, and staying committed to a vision that started with one simple belief that Indian consumers deserve access to hygienic, trusted, and high-quality fresh protein through an organized, transparent, and technology-driven ecosystem. When we started ZapFresh, the Indian fresh meat industry was still overwhelmingly unorganized. Consumers had limited visibility into hygiene standards, sourcing quality, or product consistency. And building a branded fresh protein business with integrated cold chain infrastructure seemed really extremely challenging. However, we believe that over time, Indian consumption patterns would have evolved and towards trusted and organized food brands. That belief became the foundation on which ZapFresh was built. Over the last 11 years, we've built the company patiently, one customer, one city, and one supply chain layer at a time. Today, ZapFresh has evolved into an integrated omni-channel fresh protein platform, spanning online, retail, and HoReCa channels across key consumption markets like NCR, Bangalore, and Mumbai. More importantly, we are looking at that this shift in perception from moving just beyond the meat delivery and moving into a omni-channel, more trusted fresh food and protein brand is the long-term evolution and scalability of the business. FY26 has been one of the most transformational years in our journey so far, operationally, strategically, and financially. During H2 FY26, the company delivered a very strong acceleration in scale with revenue growing to 125 crores compared to 65 crores in H2 25, reflecting robust growth of nearly 100% year-on-year. This growth was driven by strong traction across B2B HoReCa channels, deeper penetration across existing markets, and increasing contribution from seafood, fish and seafood as a category. EBITDA for H2 FY26 stood at about 15.9 crores compared to 11.1 crores in the corresponding period last year, reflecting healthy growth of around 42% year-on-year. EBITDA margins stood at 13% during the period. This is largely on account of strategic investment undertaken towards scaling operations, strengthening supply chain capabilities, expanding newer categories such as fish and seafood. PBT increased to 11.5 crores compared to 8 crores in H2 FY25, registering growth of nearly 43% year-on-year. On a full year basis, revenue from operations stood at 221 crores compared to 131 crores in FY25, representing strong growth of almost 69%. EBITDA nearly doubled to 31 crores from 16 crores last year, while EBITDA margins improved from 12.5 to 13.5, reflecting benefits arising from scale, procurement efficiencies, and improving operating leverage across the business. PBT for FY26 increased significantly to 23.2 crores compared to 11.7 crores in FY25, with PBT margins improving from 8.9 to to 10.4%. PAT for FY26 stood at 14.4 crores compared to 9 crores in FY25, reflecting a growth of nearly 59% year-on-year. And FY26 PAT includes the impact of deferred tax adjustments during the year. Adjusted for this deferred tax impact, the underlying PAT for FY26 in true form is 18.4 crores, which we believe is more accurately reflects the normalized earning power of the business going forward. What gives us confidence today is that growth is no longer coming at the cost of profitability. We are now seeing scale, operating leverage, profitability improvement simultaneously, validating the long-term sustainability of the business model, which we have tracked. One of the most important strategic developments during FY26 has been the diversification of our profitable business mix. Today, B2B HoReCa business contributes nearly 68% of our revenues, while B2C contributes 32%, strengthening scale, supply chain utilization, revenue visibility, more certainty. We currently service more than 300 restaurants and institutional customers across categories and geographies, and continue to see a strong long-term opportunity in the under-penetrated organized HoReCa segment. From a category perspective, chicken contributes approximately 50% of our revenues, while meat and seafood together contribute around 50%. With seafood itself emerging as a rapidly growing category, fish contribution increased from 21% in H1 to 27% in H2 of in overall FY26. This diversification across both channels and categories is helping us build a more balanced, scalable and resilient protein platform with stronger wallet share and cross-selling opportunities. We believe fish and seafood in particular has the potential to emerge as one of the most important long-term growth and margin drivers within our portfolio. During FY26, we further strengthened our sourcing ecosystem through partnerships with nearly 300 seafood farmers and initiated the development of an integrated aquaculture platform spread across approximately 270 acres of land in India. This initiative enhances sourcing reliability, improves traceability and quality control, creating a strong procurement efficiency across the value chain. As integration benefits continue to flow through, we expect encouraging improvement in seafood margins over the coming years. As part of a broader food platform strategy, we are also evaluating opportunities within adjacent categories, which will offer cross-selling potential, higher brand stickiness, and better shelf economics. Discussions and evaluation processes are currently underway, and we expect to provide more clarity on any strategic initiative over the coming quarters. The next phase of the evolution has now started through Niva Foods, which is a frozen ready-to-eat brand, which we have launched recently and which is receiving great response from e-commerce and across the categories. Niva represents a strategic entry into the significantly larger convenience and value-added foods opportunity, allowing us to participate in a much broader share of the consumer food wallet. The response has been good, with over 5,000 orders within 48 hours of launch in NCR. We believe Niva represents an important step in our evolution into a broader omni-channel food platform. We expect Niva Foods to contribute about 15 to 20% of overall revenues in 27, while also strengthening our presence in higher margin and value-added food categories. We also invested significantly during the year towards strengthening consumer engagement, brand visibility through participation in various food, retail, and lifestyle ecosystem events, along with targeted digital campaigns and customer engagement initiatives, continuing strengthening the position of Sapfresh as a modern trusted food brand. The Niva Me First campaign generated strong engagement and emotional resonance among younger urban households. Another proud milestone for us was the recognition received at the CII Unicorn Summit 2026, where DSM Fresh Foods was honored with the IPO Trailblazer 25 recognition. We were also recognized at AMA Futurescape 2025 with awards in innovation and brand retail partnership, reflecting the strength of our omni-channel strategy and the modernization of meat shop model. Outstanding startup in agri-food sector was another category under which we got honored by the awards. I was also personally humbled during the year to be appointed as the Goodwill Ambassador for the United Nations Sustainable Development Goals. by the Intergovernmental Institution for the Use of Microalgae Spirulina Against Malnutrition as an organization. I see this recognition as a reflection of the larger journey Zapresh has undertaken towards building a more organized, transparent, and technology-driven food and supply chain ecosystem in India. Beyond business growth, we also remain deeply committed to creating meaningful social impact. During the year, through our association with the Beti Foundation and various community initiatives, we continued contributing towards nutrition awareness, women empowerment, and social welfare initiatives. As a food company operating at the intersection of health and nutrition, we believe our responsibility extends beyond commercial success and towards building a more responsible, inclusive, and sustainable ecosystem for the communities we serve. We've also started scaling our local meat shop partnership initiative more aggressively, where we partner with neighborhood retailers by becoming their sourcing, supply chain, and technology partners. Through this model, we are helping modernize and organize local meat retail, where simultaneously strengthening Zapresh hyper-local brand visibility and distribution reach. The pilot involving 15 to 20 stores has delivered encouraging early results in terms of throughput, customer engagement, and operational integration, giving us confidence to scale this model meaningfully over the coming years. We have already identified and onboarded approximately 100 stores and are targeting to scale this network to nearly 300 to 400 partner stores by year-end. Looking ahead into FY27 and beyond, our priority remains very clear: continue deepening our leadership across existing markets, scale up offline retail presence, strengthen backward integration, expand efficiency food and value-added categories, improve automation and technology capabilities, and continue building a scalable omni-channel food platform with sustainable profitability. Based on the visibility across our existing operations and upcoming growth initiatives, we are targeting revenue growth of 70 to 80% for FY27, while continuing to improve profitability and operating leverage across the platform. We believe this growth will be driven through simultaneous scaling across the core Zapresh business, increasing contribution from Niva Foods, expansion of Areca relationships, deeper penetration across efficiency food and value-added categories, as well as contribution from upcoming adjacent food verticals, which we keep exploring. Organized protein market in India still remains in the very early stages of formalization. Rising protein consumption, increasing awareness around hygiene and food quality, and the ongoing shift from unorganized wet markets towards trusted and branded food platforms continue to create a very large structural opportunity for companies like Zapresh. As we enter the next phase of our journey, our ambition is not just to build India's leading fresh protein company, but to build one of India's most trusted omni-channel food brands. To every employee, sourcing partner, customer, investor, and stakeholder who has believed in us over the last 11 years, thank you for being part of the Zapresh story. The foundation has been built, and we genuinely believe that the most exciting phase of our journey still lies ahead. With this, I thank you all. Mehul, to take over.
Thank you, sir. Ladies and gentlemen, we will now begin the question and answer session. If you have a question, please press star and 1 on your telephone keypad and wait for your turn to ask the question. If you would like to withdraw your request, you may do so by pressing star and 1 again. Ladies and gentlemen, if you have any questions, please press star and 1 on your telephone keypad. Ladies and gentlemen, please press star and 1 on your telephone keypad. The first question comes from the line of Mr. Akash Chowdhury from EC Equity. Please go ahead, sir.
Yes, sir. Am I audible?
Yeah. Hi, Akash. Please tell me.
Hi, Dipanshu, sir. The numbers are very nice, so congratulations on that front. So I have two questions. Yep. So I think the B2B versus B2C split is 68% and 32, right? So but in the first half, I think it was almost closer, 48-52 in that range. So if you check that wise, B2C has actually degrown half year versus half year. So is it because of maybe what challenges did we face? And maybe you can give a flavor of how B2C works. Is it just store plus website or like how is it?
Yeah. So, we feel that B2B and B2C at a steady number, at a going forward, will be around 50/50 as a number broadly. Because, see, we understand that, the larger institutional consumption market is very, very large as compared to people, consuming at home, and also looking at a deeper penetration across the product profile, which is beyond chicken, and adding more fish and seafood. So under that initiative, we move towards, a little bit more on the B2B side aggressively, because we are investing heavily on the aqua side, and that requires a certain volume to be driven, because the new business which we have just formed, Varuna Aqua, is a farming business, where we will have large volumes to contain and to manage. So for that reason, we believe that we need a certain B2B, business also to move that kind of volume and stock. Now, B2C generally requires, a consistent marketing and burn overall. And while we are focusing, more on the expansion on the bottom line, we have to manage this balance. So, it hasn't degrown, but has been a conscious movement, which we have delivered mostly on the B2B side. And in the B2C, generally, it is online. It doesn't have any retail portion currently. So when I say that we will be moving towards adding more shops, retail shops, as I just stated in my statement, we are already partnered with 100 stores, and we're looking at about 300 to 400 stores. So that will, that is a, B2C story which will get added, and contribution then will go, grow very large as those stores keep increasing. I hope I answered your question, Akash.
Yes. So just to be very clear, the share should go forward on a forward basis. It should be around 50%, right?
Yes, that's correct.
Okay,
it will remain in that zone.
Yes, and margin to be maintained, because I think somewhere you said on a net level, let's say B2B versus B2C, the margin is same, even if the EBITDA kind of fluctuate across, right?
Yeah.
So
So as I said that, because we are investing in the fish and seafood category from an integration point of view, what happens is, because we've added 300 farmers also through an FPO. So those farmers need, very large quantities to operate when you do contract farming or when you start fishing. So that way you have to, accommodate and, budget for that large number of fishes and all that produce coming to you. So that gets, better, pushed in B2B immediately. So once it's, steadies over a period of time, it will always be hovering around this 50/50 number. But because of the breeding cycle, new business investment at integration level with fish and seafood, we are seeing this additional B2B coming in this H2.
Got it. So can you give on a broader level a margin profile which we can maybe maintain? Because the main concern which I was kind of getting through, even though let's say B2B has increased, not an issue, but the margin kind of just to give a number, let's say last quarter on 100 crores we did PAT of 7, and right now 126.7, right? So just to get a visibility of how can we on a go forward basis assess the margin profile as well.
The margin profile will certainly improve, because, we are looking at 20% contribution coming in the new year, in the new financial year, from the Miva range. So if you see, we have, specifically, investing in two sides of the business. One is the seafood, integration at the back end, and another is the ready-to-eat value-added product profile business through the Miva range. Both of these initiatives are aligned towards increasing the margins. And as you currently see, there are three contributions largely: chicken 50% and remaining 25 to 25 almost,
yes,
split with mutton and fish. So Miva will take over approximately 15 to 20% this year, and that will increase the margin profile significantly. What that number will be, we will see, but we are operating at, a very significantly high gross margin profile when it comes to the value-added products. And because of our controlled and efficient seafood at the back end, we will look at, a higher number. There will be an increase, in my view, approximately 20-25% overall on the margin profile.
Sorry, 20 point what?
25% approximately will be an increase overall, which we can anticipate on the margin profile.
Okay. So, if I got this wrong, so let's say maybe Meva and seafood would mostly hover around high teens to maybe early 20s as a margin, directionally, if not exact. Then mutton would be somewhere a little 2-3% down the line, and chicken would be, which is 50%. It gives us the volume, should be somewhere in mid-teens to little early teens, somewhere in that range, right?
Right.
Got it. I think you got most of the answer. I will come back in the queue.
Thank you so much, sir. The next question comes from the line of Deepak Pruthi from Wealthwise Wisdom. Please go ahead, sir.
Hi, Dipanshu. Congratulations on great set of numbers. Just wanted to get an understanding of how does your monthly transacting user in B2C look like, and how has it progressed over last 1.5 years?
So, Harsh, would you like to take that?
Yeah. So, right now, the monthly transactions that we are doing, monthly users, right, that is around 80,000-90,000 a month. Earlier, I think that number would be maybe around 1 lakh or so, right? So as Dipanshu mentioned earlier, so the focus as of now, is to build the B2B base for the expansion of aquaculture business, also to kind of, place the increased produce. So given that the B2B has increased and B2C has decreased, right? So the number of users have, decreased by around 15% in this half.
And also, I want to also add here that the Mega Food range will be now extensively pushed in the quick commerce side as well. We have already, partnered with Amazon, Big Basket, all of the other players. So the online business will continue to be at a certain level, and then the retail business will take up another portion of the pie. And that in total will combined together will be 50% as a contribution at a steady level moving forward.
Okay. And what is generally the retention rate, for a customer at a customer level? So what is your churn rate and retention rate?
Yeah, about 80-85% is the retention rate.
Okay. That's it. Thank you, Dipanshu. And all the best for coming call.
Thank you so much, sir. The next question comes from the line of Mr. Gunit Singh from Countercyclical Investments PMS. Please go ahead, sir.
Hi, sir. So what is the reason for fall in EBITDA margins if we compare with H1 and even if we compare with H2 last year?
So this is basically because of the B2B sales increasing. We have seen, a slight dip there on the gross margin profile.
Got it. So, are you saying that in the B2C segment, have we seen some degrowth in volumes and revenues if you compare it to H1?
Initially, whenever we start a new range of business, which is what we have started, the value added and also the fish and aqua business just got established. So then you generally focus on building a certain volume and to ensure that there is efficiency and there is no wastage, because essentially we are dealing in perishables. So we have to be very cautious in terms of, inventory utilization management. Otherwise, it creates a big hole if the leakages and the wastages are high. So for that reason, you have, there is the B2B channel absorbs large volume instantly. So this particular push has happened very organically, where we've got an opportunity to cater to a certain growth number from, efficiency food side of it, and also our investments in the ready-to-eat food side. These both are long-term impact situations. At short-term level, the gross margins and the category contributions will definitely move here and there. But at a steady level, as I said, that we look at a 50% contribution from both sides at a steady state.
Got it. But in terms of volumes, number of users, orders from our website, B2C orders, if we compare with H1, have the volumes grown?
So it has remained almost the same because we haven't expanded to any new markets. We are operating almost in those same cities. We wanted to penetrate and build more stickiness with the existing customer base. And also the idea was that with this new range of ready-to-eat products, if you see, we've received a great response. We got almost 5,000 orders within two days of launch of the ready-to-eat products. So that way we've been, building that stickiness on the online front rather than customer acquisition and more expansion in the new markets, because that is more fundamental to the growth rather than, just a spray and pray where you invest heavily on the marketing side and then the stickiness is not there. So also we have enhanced our technology experience. We are improving a lot and working a lot with partners now. So this year we will see more trust coming from these investments which we have made recently on the technology side and also on the product expansion side on the online channel.
Got it. So generally, if the poultry prices, broiler prices increase, does that impact our margins in any way, or are we able to pass them on to our customers?
It doesn't because we are investing in contract farming at the back end. So the strategy here is to manage the farmers and their breeding cycles by supporting them, by giving them certain advances, certain payments, earlier payments, and whatever they want to do in terms of capacity in expansion, we come as a investing partner with them. So that ensures that we get a certain price, benefit in the lieu of that investment.
Got it. So in the investor presentation, it's mentioned that we go 70% for the next 2 years CAGR. I would like to understand, if you have a concrete plan of where you see this growth coming from and which segments growing the most.
Yeah, sure.
And number two, also, if you're planning to enter any new cities, can you help us understand the amount of capex or the investments that it will take to enter any new city?
Right. So there are two. One is the retail channel, which we are extensively growing. As I said, that we've already partnered with 100 stocks who we have modernized in Mumbai and Bangalore. That number we are hoping to take to 300 to 400 number very fast within next few months or a year maximum, and that will contribute to a certain growth profile which will fall under the B2C segment. And then the other piece is the ready-to-eat contribution coming as an additional bump up of 15-20% in the overall growth. So that will also be supported by the export market, because 90% of that business is currently catering to US, Canada, Europe as markets, and currently we're already doing approximately 40 crores of annual run rate in that business. That business before our acquisition peaked at 16 crores. As soon as we have acquired, we have scaled that business within 3 months to almost more than double. Okay, so the growth is going to come from Niva, which is a new acquisition, and because it's a young project, so we will see a sharp growth in the initial 2 to 3 year horizon, and there is currency benefit from an export side as well, which we will get which will impact both the revenue and the profit of that particular initiative. And from a geographic standpoint, we will be expanding more on the west and the south side, and looking to open Pune and some of the near markets like Nashik, and also in some markets near Bangalore will be on the radar for us.
Got it. So basically, we're saying around 25-30 CR additional from Meva branch, and
more. It'll come more. 30 to 40 crores is currently ongoing. So we are at a monthly level operating at a 30-40 crore annualized run rate. So that will contribute to at least 70 crores of the overall year or more.
Got it. And around 20% EBITDA margin, is it fair to assume?
Yeah, that also will be around that range, maybe slightly more.
Got it. And currently, I think we have partnerships with 100 stores already, right?
Correct.
So we would be scaling this up to 300 to 400 stores. So can you help us understand on average, I mean, what kind of revenue and EBITDA margins can we expect from this store expansion?
Harsh, can you take that?
Yeah. So each store contributes on an average 5 lakhs a month, the revenue. And on a net basis, we earn 8 to 10% on that revenue. So, each store will be contributing around 50,000 to the profits a month. And, given that we'll be expanding this to 300 to 400 stores, right? So accordingly, the revenues and profits will increase.
Got it. And for the new geographic expansions, are we looking at expanding, from which channel? Are we starting with B2B, B2C, or with the website?
So, see, whenever we launch a new market, we don't look at it only from a B2B or a B2C standpoint. We go, across, the geography. So recently, for example, in Varuna Aqua, the newly registered aqua project which we have just formed, under that we have taken about 270 acres of land for fish farming, seeding. That is in Kanpur. That is in one land parcel is in Ghaziabad, which is a beautiful fish island, which is currently in place. And then there are places in Nagpur and also some land in Assam. So idea is that wherever we keep having our presence, we will open, and that could be through any project. Right? Let's say the fish project, for example, the Meva project is in Chandigarh. So that Chandigarh market will also open. Once we have our setup in any form, whether it is a fish farming setup or whether it is a processing setup of any kind, we open up across the categories, across the distribution side of the business. And then we look at what is the growth which is coming from which segment naturally, and then we push a certain channel. So it's that kind of a strategy which we follow.
Got it. So basically, whichever geography...
Gunit sir, I'm sorry to interrupt you. I would request you
to join. All right.
Thank you, sir.
Thank you.
The participants, in the interest of time, we request you to restrict with 2 questions in the initial round and join the queue for more questions. The next question comes from the line of Mr. Sri Nagesh Burgucherla from Sub Capital. Please go ahead, sir.
Yeah, good morning and congratulations for the great numbers. I have just
good
a couple
morning.
of questions.
Thank you so much. Yes, please.
Meva has shown encouraging traction, but frozen foods is a highly competitive category. So what sustainable advantage does the brand possess against large FMCG players?
So, in food, what we see is that the palate is, differs from one audience to another audience. And I'm sure, I'm assuming that you are in South. So, for you to consume a product coming from South will make more resonance. We have tracked taste profile of a North audience. Okay, so the same North audience is sitting in US, Canada, and those markets. So the idea is to tap a certain taste profile of audience, which is North Indians, who are stationed internationally. They don't get options to have this kind of a product taste profile. For example, we are looking at frozen as a very broad category, but when we go a little deeper and understand in frozen which are the leading products, you will see French fries to be topping the most, the nuggets to be topping the most. Okay, we are not in those categories at all. Okay, so there is a serious differentiation which we are bringing in the product profile as compared to the hero products where the large competition is already existing. So we are not touching those categories at all. Okay. These are very gourmet line of products which are snackables for the NRIs who are mostly from the North Belt, and they could be craving and missing a taste which is coming from India, and that too the roots from the northern side. They feel they are the right customer segments, and we don't think there is any other competition, very strong competition in that side of taste profile, which is available for them internationally. Domestically, however, the strategy will be different to cater to the retail shops which we are taking over, where we will set up and start giving them products like seekh kebabs and tikkas and multiple other products, which will be complementing to the existing line of fresh products. So that I think will be still falling under high competition side of the business. But when you look at export and international market, we have a very strong edge in terms of differentiation from a taste profile point of view, which is already established. So it's not that we are establishing it. They've already cracked, some customers, but they were not able to scale and there were other issues. So we took over that business. Jubilant is one of the customers. Some of the Punjabi communities in Canada, who are looking for their authentic taste, are one of the buyers and then US, we are doing bang and kabarta. So a very wide variety, extensive range is available to us to focus towards the different target audience internationally, and domestically everything aligns to the core business complementing. So what complements the core business is how we are going to move from a product strategy point of view. So product strategy overall in the domestic market is evolving, but largely will remain closer to what we do in the protein side.
Okay. My next question is, over the next 3 to 5 years, how important do you expect value-added and frozen products to become in the overall revenue mix?
Oh, that's a very okay. I see that there is a very strong investment and belief which we have recently shown with launch of the new range of Niva foods. The capacity which we have currently is 500 crores of revenue, which we can do only in Niva from a point of view of land, plant and machinery, everything available in Chandigarh, which is there. It's a state-of-the-art plant. So we have the capacity and capability to do that kind of a number as of within a year. Okay? Now, when it comes to how much it contributes, is really, difficult to say as a number. But I say that overall in the scheme of things, it should be approximately 20-25% minimum of the total revenue. Which is a good number.
Yes. Thank you so much.
Yeah.
Thank you so much, sir. The next question comes from the line of Mr. Lakshya Seth from Emerge Capital. Please go ahead, sir.
Yeah, hi. Congratulations on the strong performance and execution, sir.
Thank you, Lakshya.
Sir, so does the partner store model materially improve our customer acquisition economics and brand visibility compared to the channels that are purely online?
Significantly. So if you look at, any localized physical distribution business, let's say if you look at Oyo or 1mg, or you look at, Farm Easy, all of these guys have demonstrated a very deep penetration in the local clusters. And, I mean, a lot of people were not aware of them just online as a player, but they have seen their stores. And that's how they see a overlap where offline and online, combines together and creates a very digital kind of an experience. So we are moving in that direction only. And I think that this is going to be, a very, very differentiated playbook, which will create maybe thousands of stores as we move forward in the coming years. These 100, 200, 300 stores are still, very, very minuscule of what exists out there. And also think of, tier 2 markets. Right now we're just doing tier 1. So tier 2 markets itself, are mostly, they do online, but, they have more time to go out and purchase. So we want to capture both sides, and that will create a harmony amongst, both the segments, and we will see brand visibility going very high with the offline approach. It's a very inexpensive way to build a brand.
Got it. And sir, one more question before I join the queue again. So as multiple growth initiatives are being scaled in the business simultaneously, so according to you, which areas currently represent the biggest execution risk for the management?
Biggest execution risk. I think, we are looking at, from a macroeconomic point of view, I think the war as a factor is a risk for our business, because we're now looking at exports and shipping outside the country, some raw material pressures. So all of those things, are the only risks I foresee.
Got it. Thank you, sir. Thank you so much. I'll join the queue again.
Thanks.
Thank you, sir. In the interest of time, requesting the participants to stick to 2 questions in the initial round and join the queue for more questions. The next question comes from the line of Mr. Sahil from STR Investments. Please go ahead, sir.
Hello.
Hi.
Am I audible, sir?
Yes, please continue.
Congrats on a great set of numbers, Dipanshu. So my question was that you mentioned that we are going on a 60 to 70% growth for this year. We are targeting that number. So can you break it down in between the different segments that you are catering to? Like Zapfresh organic will be this much, Miva will contribute this much, etc.
Yeah. So as I said that Miva will be about 15 to 20%. Fish and seafood is already currently at 27% of contribution, which will move to at least 30 to 35%. And remaining mutton will be reduced further, and chicken will remain around 40 to 45% from a category point of view is how we are looking at it.
And on a Concall basis, the margins that we are targeting are similar to FY26, or we can expect more growth going forward?
So there will be 25% improvement on the bottom line, because there was a deferred tax element also, if you see in the balance sheet, which has been going for the last H1, H2 both impacted it from the previous years. So that factor will not be there next H1, and we will see the improvements drastically on the bottom line then, because effectively the true profit after tax, considering the standard tax slab rate, will come around 18 crores. So there is that additional 10, 20%, 15% deferred tax element which will also go away, and also looking at additional contribution of the ready to eat project, which is a high margin profile business, will also impact drastically.
All right, sir. And sir, one question on the acquisitions. I read some articles on ET, etc. So are we looking for some further acquisitions as well as part of our business operation?
So nothing is in immediate pipeline, because acquisitions, takes a long time, and we have our hands full currently. So the idea for us right now is to consolidate the new acquisitions and the new initiatives which we have done, which is the fish and seafood project and the Miva range, These two projects are keeping us very busy along with the retail penetration going on. So we'll see if there's a good asset coming our way, then we'll look at, but otherwise there's nothing immediately which is tied up.
Thank you, sir. The next question comes from the line of Mr. Prashad Shetty, an individual investor. Please go ahead, sir. Prasad, sir, please go ahead with your question, sir. I believe there is no response from Mr. Prashad Shetty. We'll take up the next question from Mr. Surendra Reddy from Chartered Investments. Please go ahead, sir.
Yeah. Can you hear me, sir?
Yes. Hi, Surendra.
Yeah. Hi, sir. Thanks for the opportunity. Sir, I have two questions. So the first one is, I'm just observing across the sector, so all the participants are actually loss making and we are only profit making. So main reason for that, and also whether these profits are going to be sustainable going forward. That's my first question.
Yeah. So the reason we are profitable as compared to the other peers is we follow a backward integrated project, sort of a integration strategy, where we partner with the farmers directly, and then that gives us a benefit of operating at a better quality, better margins. When we buy the live bird, we liquidate the entire live bird. So to give you a specific, 1.6 kg is the weight of the bird. And generally what the peers do, they buy a completely clean slaughtered bird. What we do when we buy the live bird, we are able to sell off the ancillary products like the feathers, the piece, etc., which is part of the unfinished product, and that impacts the bottom line and the profitability procurement. And also we are able to work with small and medium sized farmers and integrators. That also gives us better control on the pricing overall. So this is one of the major differentiator with respect to the other guys. From a sustainability point of view, yes, the margins will be sustainable. We are investing in more high margin profile businesses and products. So we continue to remain stable on that side.
Yeah. And a follow-up question for this point. Yeah. Sorry, there is a follow-up question for that. Where could we see our top line and bottom line in next 2 to 3 years?
I would, I'm hesitating to give you a specific number, but we have given it in our PPT. The growth, has been at a CAGR level. We have been growing at 50-60% if you see overall. And because we have opened up new businesses and we are investing in new lines of products, this growth will be continuing for the next 2 to 3 years.
Okay. Yeah. Okay. Coming to my second question, sir. Sir, actually, I can see that there is a huge distribution in the shareholding pattern. So, the promoters are holding very low shareholding, just 28%. So, is there any plan to buy the shares? Because I'll be executing the warrants very soon. There was a lock-in for me to buy any shares through the warrant instrument because of the lock-in for the IPO and the financial results announcement. So all of that is completely now out. So we will be exercising warrants and I will be adding more equity. That's correct. Yeah. Sir, thank you very much, sir. So I have just 2 suggestions. One is try to just provide a quarterly business update. And the second thing is plan more investor meetings going forward, sir.
Okay. Sure. Thank you so much. Our advisor, Go India team should actually make a note of that.
Yeah. Thank you, sir. Thank you very much, sir.
Thank you so much, sir. The next question comes from the line of Mr. Achyut Pabat, an individual investor. Please go ahead, sir.
Hello, sir. First of all, I want to congratulate on great set of numbers. But only one thing I am not able to understand is what about the cash flows, sir? Cash flows are going bad and bad every year. So when can we expect improvement in cash flow side? Do we have any plan to raise funds to continue our business, sir, in future? How much cash we are in currently?
Harsh, would you like to take that up?
Yeah, sure. So in terms of cash flows, obviously, if you see, cash flow from operations, you will see negative amount there. Although, we are generating a good amount of EBITDA, right? And that is because of expansion in the scale and the revenues. So as we scale, obviously, we have to invest in working capital, and that's why the overall cash flow is negative. Coming to your cash point, as of now, we are sitting on a very good liquidity, wherein we have approximately 20 to 25 crores of cash. And for future also, fundraising we have a good headroom there in terms of raising debt as well, because if you see our leverage ratio as well, right, it has reduced in FY26 from FY25. So if you were to see the net debt to equity ratio for FY26, it is below 0.5x as of now. And we have good visibility in terms of securing additional debt lines to ensure that we have sufficient capital going forward for all these initiatives that we want to undertake in this year.
So when can we expect positive cash flow, sir? Do you have any timeline for that? I mean, are you planning positive cash flow in the near future?
So see, I mean, it is difficult to give a timeline because it is a factor of growth. So if we were to decide today that we want to, pause the growth and maintain this scale, we can do that and turn the cash flows positive, right? But that's not the focus, I would say. But anyway, I think I see in 2 to 3 years is something that we'll be expecting to kind of, generate positive cash flow from operations post the working capital investment.
Thank you for that answer. Thank you.
Thank you so much, sir. The next question is a follow-up question from Mr. Gunit Singh from Counter Cyclical Investments. Please go ahead, sir.
Hi, sir. So I would like to understand more about the EBITDA margins. They were 17% last year, now 13%. So out of this 400 basis points delta, can you help me understand what are the sort of one-time costs for, the aquaculture or all our initiatives, which might not flow into H1 FY27?
So, go ahead, Raj.
Yes, I think you're referring to H2 FY26 compared to H2 FY25 and the 400-500 basis points drop in EBITDA, right? So the main reason for that is the change in the contribution of B2B and B2C, right? So if you were to see in FY25, the overall contribution from B2B would be in the range of around 20 to 25%, which has increased to now close to 70%, right? And if you see the gross margins, obviously the gross margins are different in both these categories. So B2C would be around 45-50% and B2B would be around 20 to 25%, right? So significant difference there. And that's the major reason for the drop in the margin.
Got it. So in FY27, what kind of EBITDA margins are we targeting? And given that our B2B is heavy right now, so basically, what will be the drivers?
Right. So over the next 2 years, we are targeting an improvement of 3 to 4% at least in the EBITDA margin. This will come from 2-3 things, right? So one is the aquaculture bed, which will contribute 200-300 basis points on the fish contribution. Second is the expansion of the ready-to-eat business, right? So that business operates at a much higher level of margin. Gross margins are approximately 50% there, right? So increasing share of ready-to-eat. And third, as Dipanshu mentioned, right? So in long-term or medium-term, the objective is to maintain the B2B and B2C split at around 50%, right? So again, once the B2C component increases, the margins will also increase simultaneously.
Thank you, Gunit sir. So we have another follow-up question from Mr. Akash Chowdhury from EC Equity. Please go ahead, sir.
Yeah. So the B2C which we talk about is it just the website or the physical store?
Just the website. Just the website. The physical store are still building up. So that's why I'm saying that there will be a stronger push which will be coming from the stores in this financial year.
Okay, so store is also B2C, right?
Yeah, store is also B2C.
Okay. One confusion I had. So I think so right now, let's say website is the prime source of B2C, and I think the B2C is reduced because we might be doing less of advertisement and all, right? So maybe let's say on a Meva level, if we push through quick commerce, so there also the margins would be affected, right? Because quick commerce takes a lot of margins out there.
No, that margins, no, it will be increased. See, Meva coming in is a straight bottom line impact in any form, whether it is sold in B2B, whether that range of product is sold online, or whether that product is sold on retail, because of high capacity and capability on that side, we will be operating at a very good margin.
Just to add here, Akash, the margin structure of Meva products and for the core Zafresh products are quite different, right? If you just compare the gross margin, there is a significant upside in the ready-to-eat category of around 25 to 30% on gross margin front, right? And if you would be aware, the normal commission or marketing that is spent on this channel, the e-commerce channel, is around that range. So the ready-to-eat products specifically will be able to absorb that cost, incremental cost that happens on quick commerce side. And that's why if you see for core Zafresh products, primarily we have targeted our own channels only online. We have not delved too much in the quick commerce side as of now because of the margin profile right there. And that's one of the also reason, that's one of the reason that if you compare with our competitors, right, which would be loss-making as of now and we are profitable, that's one of the reason, because their primary sales online happens through these quick commerce or, online platforms, third-party platforms like Blinkit, Zepto, etc., right, wherein they have to incur commission and marketing expense, which we don't have to incur.
Thank you so much, sir. In the interest of time, that will be the last question for the day. Now I hand over the floor to the management for closing comments.
I really, appreciate everybody spending time and showing interest and their trust in our project. We continue to build, a very iconic organization and a large conglomerate in the coming years. And I'm looking forward to engaging again, next time with everybody. Thank you so much.
Thank you, sir. Ladies and gentlemen, this concludes your conference for today. Thank you for your participation and for using DSM's conference call service. You may disconnect your lines now. Thank you and have a pleasant day.
Thank you.